Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This episode features my second conversation with Barry Roach. Barry used to be running Water and Power Community Credit Union here in the Southern Los Angeles area and has more recently joined Upstart. So full disclosure, he does work at Upstart now. Barry and I do what I hope will be a regular repeating pattern for bringing back guests for a second interview and holding their feet to the fire on their bold prediction. So he made a prediction about bank and credit union consolidation, grades himself on that. Barry also, we talked a little bit about his bold prediction for this year in terms of what may happen to the macroeconomic environment. Got a little different point of view than many. I will point out that Barry's perspectives on that are Barry's and not his employer's, Upstart's. But I do think that he's got an interesting perspective on what the future may hold. And he also talks a little bit about what brought him from the credit union industry to Upstart and where he thinks his beliefs of the macroeconomy really lead to in terms of advice for banks and credit unions and community banks in terms of investment through the coming macroeconomic environment. So kind of what you can take away from where we are and where we're going and what that maybe means strategically for investments to be making. So another fun conversation, a repeat guest, which I hope becomes a little bit more of a regular on the show. But please enjoy this second conversation with Barry Roach. Barry, welcome back to the podcast. It's great to have you here again.
Thanks, Jeff. Great to be here. Well, you can hear my dog in the background. Sorry about that.
You know, everybody's got it's the new world, right? Home is the office is home. At least you're not the guy. Do you remember the North Korean expert whose kid ran in the thing and then his wife ran in and pulled the kid back and right while he was on CNN? It's like that was the dog. It's a normal thing now. We don't even notice.
We hope that won't happen today.
I don't know about you, but I don't have a kid in a toddler chair around the house. I think we're safe on that front.
Yeah, those days are over.
I figured we should start the episode by letting the audience know that you've shifted responsibilities and roles in companies since the last time we spoke. So why don't you give everybody the quick update on the life of Barry Roach and where you're at these days?
Sure. Thanks, Jeff. So I was the president and CEO of Water and Power Community Credit Union in Los Angeles. Last time we spoke, I was in that chair and enjoyed my 5 years or so there. Really had kind of accomplished everything that we had wanted to do with the credit union. We had turned some financials around from when I first got there. Did a whole digital transformation, turned over, brought in some new talent to the group and so on. Expanded the field of membership, which of course is a big deal in credit unions, to be able to serve more people in the community. And you know, the credit union mantra is people helping people, and that's kind of always been within my personal ethos of how to things I want to do in my personal and professional life. So the Upstart opportunity was really a new challenge for me, but something that I kind of embraced because this company, as I knew from being part of the credit union and being a partner with Upstart at the time, really sort of embraces how we can provide affordable access to credit to more people. People helping people. I mean, Upstart really sort of espouses that as well. So it made a lot of sense as I was looking for new opportunities to come over to Upstart. And I just feel so fortunate that I'm here now with this company and working with you and some others around it. It really is an amazing company. And I knew that when I was with the credit union. But when you actually get inside, you go, wow, these people really are. I mean, for one thing, they're very nice. And I don't mean that in a cliched way. Like, I have not spoken to anyone here at this company who has made me reconsider my decision to move to Upstart, or they've even reconsidered their decision to be with Upstart. It really is a mission-driven company. It starts with the founders. And Jeff, you were there right at the beginning with our CEO and so on. But no, it really is mission-driven and really is one of those companies that makes me feel good about doing what I'm doing with the company.
Awesome. Well, welcome to the team officially. And I'm going to ask you this. I always joke when I make people give me their bold predictions that they'll have to come back on the podcast and face the music on how they did. So here's my opportunity to actually hold some feet to the fire. I think your bold prediction was something around continued consolidation of the banking and credit union market. How do you assess your accuracy on that?
Well, I'd say it's 100% accurate, but I will correct myself. It's not necessarily all that bold. Let's be honest. Consolidation's been happening in credit unions and banks for a long time. Um, it's for the past 40 years. I think we've had around 3 or 4% consolidation in the industry every year, and that happened as well in 2022. So I don't expect that to change much in 2023. We'll probably see that same rate again.
So I've always joked, Barry, that when I bring my guests back, that when they make a bold prediction, I'm going to hold their feet to the fire on how they did. And if memory serves, you made a bold prediction about the continuing consolidation in the credit union and bank space. How has that prediction fared in your estimation?
Yeah, I'd say it's 100% correct, but I will also correct myself that it wasn't necessarily a bold prediction because as I look back and did a little research on, there's been consolidation about 3.5 to 4% on both banks and credit unions for the past 40 years, and it's a pretty straight line trend if you look at it. And the same thing happened in 2022. It was about 3.5%, I think, consolidation. So I remember when I first started in the credit union industry in 2005. My CEO at the time said to me, in the 70s, there were 20,000 banks and 20,000 credit unions. And now there's 8,000 banks and 8,000 credit unions. This was 2005. And now you look at, and there's about 5,000 each of banks and credit unions in the country. And that number keeps dropping. And you look at new credit unions that are being started, new banks being started, it's really in single digits, maybe a handful. That consolidation, that merging of institutions is still in the hundreds on an annual basis and necessary in my observation. You need to have scale. You need to have the ability to, you need to have enough of a size to be able to have the right value proposition that your people deserve.
Yeah, it is fascinating. It's one of those things about the industry that I didn't know until you start looking at the history and we started selling to banks. How big is the market? How many banks are there? And then, you pull up the trend of what that number was in the 90s and the 80s and the 70s. And that trend is remarkably stable and steady, actually, in terms of what it's looked like in terms of the consolidation of the industry. And you're right, maybe that was an accurate and good prediction, but not the most bold. We'll make you make a bolder.
Not the most bold.
Not
I will say that. But the pie is growing. I mean, even though we've had this consolidation, assets continue to grow, right? So collectively, the financial services industry is much larger than it was 40 years ago. It's just there are fewer players in it. And I think that over time, maybe in the 70s, you could get away with a much smaller institution because maybe the member or customer expectations were less. We didn't have the need for digital platform. As long as you had a branch on a corner and that branch was open in hours that served your customer base, your membership base, that was okay. And we all know branches are still important, but it's the expectations for consumers are way beyond that now. You can't just get away with just a branch and a call center. You need to have a digital platform, and it needs to be a good digital platform that people can actually use. Even chat nowadays is not just a game changer; it's kind of table stakes, right?
Yeah, it is true. And my willingness to, it was interesting. I moved a bunch early in my career, and when you moved, you felt like you needed to maybe move your bank because I wanted somebody who had a local branch. When I traveled, you couldn't access services as easily. And now I can open an account one place, move somewhere else, and go, I don't really need to change my bank. So I have a closer branch or a local thing. It's all of a sudden there's the ability to use the in-person, the branch when I want it, but not make it kind of a requirement, a contingency. So I think the average institution can serve a broader population set than they could have 20 or 30 years ago effectively where, and we are, it's funny you mention the digital, but so much of the systems infrastructure still has to be updated. I remember when I moved once, this kept the same bank, but because the bank was a merged entity, they said, well, you can't make deposits at the ATM above a certain amount because you have an out-of-state account. I said, well, what do you mean it's an out-of-state? I mean, I know I opened it when I was there, but now I'm here and it's the same bank. But they still had systems that were separate for the different institutions. Well, it's different. And so they made me close an account and open a new account just so I could, ATM deposit my paycheck back in the day in my new location. So it's really interesting that the consolidation has also forced a lot of infrastructure improvements and consolidation of systems to be able to actually deliver that kind of seamless experience for a
Right.
customer.
And I think we've also sort of corrected ourselves in the industry with some of the rules. There are always rules around this. Well, Jeff, you're out of state. You can't do this, right? Then after a while, you go, well, wait a minute. The guy down the road is able to do this. Why can't I do this? And a lot of it, at least I found in my experience, not just in credit unions, but banks as well, these old policies, these old ways of doing business, and no one sort of rethought that. And I know when I went to different new credit unions, I go, well, why do we do this? And they go, well, we've always done it that way, and that was always sort of the default answer until after a while it was preceded by a laugh. It's like, well, we always do it that way, and then you realize, well, wait a minute, why are we making people jump through hoops? This is not the kind of customer or member value proposition or experience that we're trying to do. So consolidation of systems makes it a lot easier, but I think that we've all collectively gotten a little smarter about this stuff as well, and realized that, hey, there are a lot of other financial institution provider or financial services providers that have far less friction in that experience than traditional banks and credit unions. So we are as an industry trying to alleviate that.
Yeah, it reminds me of there's this problem analysis approach used in many tech companies called the 5 whys. You heard of the 5 whys? You ask why. I try and teach this to our sales team all the time because we'll get questions from a customer about how do you do this? And they'll just try and answer the question or give me data about X. I go, well, why do they want to, it's the same thing with your rules, right? Well, there's a rule against large ATM deposits into an out-of-state account. Well, why? Why?
Right.
And why was that an important rule? And what is it trying to actually achieve? Well, before nobody had an account from out of state. And so if it was like a high risk of money. Well, yeah, but like that, so there's a reason, there's a thing you're trying to prevent. There's a rationale, but you kind of have to understand the rationale to understand how the rule maybe should shift or be reapplied in the new context. And that kind of,
they were valid reasons at the time, right? Yeah. Very valid reasons, but the game has changed, and it's not necessary to have those sorts of reasons.
And that's why you got to understand why the rule was there, what it was trying to achieve, and then go, okay, in the new world, what's a better way to think about achieving that objective that maybe isn't that rule? You can't deposit more than X dollars in an ATM from into an out-of-state account. Right. What was the problem? What was the reason? How do we find a way to accomplish the objective without following the process? It's a great point.
Completely. And by the way, my bold prediction from 2010 would have been there's no more branches by 2025. I think we were all predicting that at the time.
You missed that one.
And look where we are now.
I'm glad you weren't on the pod. We'd have to really hold
I would have.
What's your take on that now? I mean, I hear lots of interesting takes on, there's a lot of cutting of branches a handful of years ago. There's now some reopening of branches, maybe consolidation, but not with the vision towards elimination, but kind of like a fewer number with a different kind of purpose. What's your sense on what, the future of the branch and its role in the ecosystem of financial services is?
Yeah, I think branches are here to stay. They're probably always here to stay in some way, shape, or form. Like, I started my career as a teller, and I still remember 3 p.m. on Friday, there would be lineups out the door with people coming in to cash paychecks. And of course, those days are long gone with direct deposit, right? There were also 68 employees in that branch, 68. So think about that, right? I mean, we've got at Upstart bank and credit union partners who don't have that many employees in their entire company because it's not necessary, right? So the advent of digital banking certainly made it a lot more efficient for banks and credit unions to deliver that service, but also a lot easier access for customers and members. But there's still going to be a need for branches. There are still those services that people do need to go down for. People still use cash. There are reasons to use cash. And that's the other bold prediction. Cash isn't going away anytime soon, although I know there's some European countries trying to do that and so on. But it's not going to be replaced by crypto anytime soon or anything like that. So there's cash needs. And simply, I know people who maybe they're taking their child down for the first time to get an auto loan. And they actually want to speak to someone face to face, in person, and kind of get that trusted advice that they can get from their bank or credit union down the corner. I don't know if that ever goes away, Jeff. We can still do that stuff online. I can still speak to someone over video chat at a bank or credit union, but there's something about going down there and opening that first savings account or getting that advice, or even speaking to an investment representative about how am I going to save for retirement, or how am I going to save for my first house? I
That's
think
always
there's
been
still going to be
the
there.
because there's always been a line I've seen, which is kind of like I used to have to go to the branch to transact, and I don't want to do that anymore, right? Like I don't need
No,
to go in to deposit a
you don't
check
have
or
to.
even go to I used to go to the ATM and sign the check. That was like huge step up. No more standing in line to deposit your paycheck. You could like just drop it off at the ATM. And now I don't even have to go to the ATM, which is much better, particularly when it's cold or
Right.
rainy. But that moment where you go, I don't know what I want. I don't know what I want to do. I know that I want to save for retirement, but I don't know how or what that means or what my choices are or how to think about them. That's a very different moment than I want to check my balance. I want to deposit a check. I want to withdraw cash. Those are transactional and they're easy. And I think people, by and large, there are some exceptions, but they don't want to go to a branch to do that. They just want to be able to do that as easily and seamlessly as possible. But when they go, how do I save for retirement? They don't want you to give them like a 45-minute video and a 50-page FAQ. They want to talk to a human being and have a discussion about what is the best option for me and how I handle this scenario. And I think that's the thing that's going to be important to figure out how you do.
Completely. Yes.
All right. So now, if I 2010, you got a bad prediction. 2022, you got an accurate but somewhat less bold prediction. What's your 2023 outlook like? What's your bold prediction for this year?
So, and this is a bold prediction. Personal opinion, I don't think that the recessionary fears that we have right now are going to actually come to pass. I don't think it's going to be quite as bad as we all think it's going to be. The labor market is still pretty tight. I spoke to someone yesterday who she runs an employment company, career counseling, and so on and so forth. She says some of her business customers have cut back a little bit, but there's still an awful lot in the pipeline for skilled employees looking for that next job. And it's not out of necessity as much as it's more out of their own sort of personal interest in trying to improve themselves professionally or to get sort of that higher level position. Um, so the term out there is a tech session, and we've seen that with some. Microsoft just announced a layoff. Google has. Apple, no, Apple hasn't. Pardon me, but Facebook did last year, and so on. Even Upstarts, we're not immune to any of that stuff either, because it's kind of necessary in the businesses that we're in. But you've still got unemployment below 4. The Fed, recognizing that the Fed and the market don't always react in the same way. The Fed, there's a signal that they're going to increase rates again, maybe twice more, and then pause this year, smaller increases. But the market doesn't see that. 10-year treasuries are less now than they were in October. And even though we've had one or two Fed rate increases since. So I think the market sort of understands that we may be near the top for interest rates right now. So yeah, certainly it will have an effect on consumption, but inflation's coming down a little bit as well. Even gas prices are down a little bit. Housing wasn't really great in 2022. Anyhow, it's going to be worse in 23. But there's still less single family houses out there right now than there are buyers. You may just have buyers deciding not to enter into those transactions now because the price of the real estate is too high, or the cost of the mortgage is too high. So they are purposefully staying in the rental as opposed to entering into the housing market, and all well and good. So I don't know. The economy, of course, has tons of different data points and tons of different factors and around it. But I personally think we're going to be okay. It's not. It may happen. It may be a technical recession. With reduced GDP or negative GDP, but I really don't see it happening for much for very long or being very severe.
You're predicting at worst a soft landing of some sort, that kind of the soft landing version of the. I thought your point about the tech session was interesting. We've certainly seen a number of layoffs from tech firms, but also, I mean, Goldman Sachs has done some. Like, I think it's, my sense is it's somewhat the stress that was placed on the lower income consumer earlier in the cycle, kind of reaching its way and kind of trickle up, if you will, into the higher income, more white collar job category. But in a way, it's kind of the end of the process, because, for many that stress started earlier during the pandemic, and we're seeing kind of the last end of that hitting the peak. But it's not just tech, but it is certainly a thing that's going on. Although I saw an interesting stat the other day that despite all the talk of the layoffs in tech world, that over the last 12 months they'd hired more people than they just laid off. So it was, they still are net growth in employment year over year from where they were. It's just a matter of like they went and reduced some of that growth a little bit effectively. But still, still if you look at the year over year numbers, it's growth and overall employment in each of those companies, which is pretty different than what you think of as the beginning of a harsh recession.
No, you're right. I mean, look at the swings we've experienced in the past 3 years, right? We went from sort of like pre-COVID, rates up, rates down, unemployment up, but pretty much along there were upper and lower boundaries that were pretty narrow. And then COVID hit, unemployment spiked up, right? Stimulus came in, unemployment dove, right? And then you had companies just hiring anyone. It's like, we need people. Because you had suddenly people left the workforce and there weren't enough coming in to come back. So, that's sort of a swing. Interest rates, we used to joke about in ALCO about a 300 or 400 basis point rate shock. Well, that'll never happen. Well, that happened. We actually saw that shock, and we saw it going up. And I don't think it's going to shock down the same way. It should be a slower landing. But we had similar shock back in 2003, 2004. I mean, the Fed was increasing rates, I think 25 basis points each quarter for, I don't know, it was 6 or 7 quarters, and it went up into the 4s or 5s, and it gradually came down. Then we went into the Great Recession, but I think those were different circumstances that got us into the Great Recession then. That was just sort of the real estate bubble, and we don't have to rehash all that stuff. But we've had swings in the past, but we've enjoyed a pretty, I'll say, benign economic environment for the past decade, and it's tougher for everyone to maneuver around that right now. And there is a lot of fear, and that fear is real. I just don't necessarily. I think that all this stuff is going to slow down. I think we're going to go back to a more normalized economic cycle here sometime soon. Even if there is a little bit of a recession, I think we're all going to be okay. I mean, Jeff, you traveled over the holidays. Did you see signals of recession when you were traveling? I mean,
no, it looked.
I didn't.
It looked pretty normal to me on the travel.
It looked abnormal. It looked like people were like, "Hey, I can travel again. Hey, I can go out and spend money."
People were running through. I was international, so they were running through the duty free store buying stuff, and it did not look like a stress time from that point of view.
Right, and they also say malls are dying. But I went to the mall I'm talking about. It's close to where we both live on the 23rd, and that place was a zoo, as it should be, 2 days before Christmas, and so it's good. I'm glad that people are out there and people are consuming and people feel that they can consume. I think that's just bullish for the economy.
Yeah. If your prediction's right, what does that lead you to believe about the strategy a bank or credit union takes, now through this year? Like what do you start investing in? What do you start doing differently if you start, maybe not everybody believes you yet, but they're saying, hey, I'm watching for the signs that Barry turns out to be right. If things turn out that way, strategically, what does that mean I should be focused on thinking about doing for the next year?
Well, I'll have a caveat with that first, that for some, their hands are tied. Liquidity is tight. There's no question. We went from, as an industry, having an abundance of deposits to suddenly and very quickly, those deposits all went out. They either in consumer spending or in sort of an abnormal lending cycle that maybe we didn't see that signal. We kept lending even while deposits were dropping at a much higher rate. So, but assuming that institutions have sufficient liquidity to look after sort of their day-to-day and the strategic items they want to do in the next year, look, we haven't seen loan yields this high since when? I don't know, 2007. Like honestly, I'm talking in all asset classes, right? So if you think that you may be at the top of the rate cycle, and again, this is my opinion, it's not advice, but wouldn't it be great to lock in as much as you could in those higher loan yields? And even if you think there's some elevated risk with some of those asset classes, the increased yields you're getting off that can kind of overcome some of that risk. You can pack a little bit more away in terms of what you may feel might be a loan loss down the road. So, and the consumer, I think, is still there, not in the real estate market, but people are still buying cars. People still are using their credit cards. They're using it more than they have been the past couple of years. and there's still a need for personal loans. So if I have the liquidity, if I have the ability to lend, why wouldn't I do that now when I can, again, lock in those yields that I haven't seen in over a decade?
Yeah, I think it's. I think a lot of people are starting to look at my sense reading the market and talking to people is they all want to believe that what you think is coming is coming. They're maybe waiting for one or two more data points that the landing will be as soft that there won't be a turn in the credit cycle in terms of performance. That's we're seeing some elevated losses today versus maybe better times, but they're kind of stabilized and people are going, well, it looks like we're going to be on the everything's getting better trend, and this is a moment that's obviously the moment of most opportunity, if you can call when that is. But I think people are waiting for one or two more prints of things looking, stable to getting better. And then, then it is a moment of opportunity, both to lock in yields. And I do think there's always an advantage for the financial services players who are first back in the market because customers are looking for that loan. And you've got an opportunity to win business and win loyalty when you're the first one out there making the offer. You can go out and compete in a slightly less competitive market if you are a little faster to react than the next guy. And that's an opportunity to win some business and win some mind share, win some new customers when the competition's a little tighter. Because obviously when the world is clearly in a better place, then everybody wants to be back in the game.
Right. So what signal is it to get you doing that in the first place, right? And I fully acknowledge I'm not in that CEO chair anymore. It's really easy for me to sit here and talk to you, Jeff, and say, hey, this is what I would do. Well, it's different when you have a board to report to and you've got a company you're trying not to drive into the ground and things like that. So I get that. But it's like every other financial decision you make when you're a CFO or a CEO. What is my out? What is my plan B if it doesn't work the way that I want to? And I just think that there is a composition of strategy in 2023 that doesn't mean you have to stop lending or that you even need to slow a lot of lending down. There are ways that you can figure this out. And I've talked to some of our credit union partners at Upstart. I mean, they're figuring it out. They're still, in some cases, they're lending businesses as much in 2023 as it was in 22, and certainly more than it was in 21. So it's some are willing to make those bold moves right now as well.
So I guess it's the moment of opportunity for those who are watching.
I think so,
and a good time to figure out how you can either start taking advantage of or position yourself to be able to take advantage of, the period of opportunity. If Barry is right about the futures there. Now, it's always fraught to make predictions about the future. We've done all these kind of correlations of macro factors, and our machine learning team will tell you that it is like the worst possible problem for machine learning because there's so few examples of turns and cycles. In the old wisdom about recessions is kind of true. Like whatever the next cycle is, it will be different than the last. And the only thing I know about it is it's not going to look like the last one. So it's always kind of hard to predict, but it does feel, I think I like the sense of optimism. It is a little bolder than last year. You're bucking the trend a little bit more than predicting the continued consolidation.
A little bit. Yeah. So look, there's many economists out there that are predicting a wide range of it's going to be really bad or it's going to be sort of bad. No one's saying it's going to be good, right? Let's be honest. I'll go back to what you asked before about my decision to move to Upstart. What has thoroughly impressed me in my short time here at Upstart, and here's a little plug, is that we truly take a data-driven approach to everything we do. So our lending partners came to us and said, okay, well, how is Upstart considering macroeconomic risk with maybe a recession coming down the road? And this wasn't Upstart employing an economist or using bank economists or others to sort of come up with a prediction. Upstart said, well, we have a ton of data on this. Let's plug all this data in. Let's build a model. Let's see what it looks like. And so for two things I love about that. One is it's not just an opinion. There is some fact and data behind what we're characterizing as a factor for macroeconomic risk. And secondly, like a lot of companies would try and shy away from that, or they might go, well, don't worry about that. There's always going to be a macroeconomic risk in any loan transaction. We'll account for that in other ways. But no, we really sort of ran into the burning building on this a little bit to try and come up with a real number. And so my little plug for Upstart is I thoroughly appreciate how we tackle these hard problems problems, which frankly, every financial institution professional is trying to get their arms around this. We again are taking that data-driven approach to it, I should say,
Yeah,
which is
I will say that
inspiration.
expect to hear more from us on this topic in the near term as we codify this. But I think we are both very data driven and cognizant of the limits of data, which is to say you can measure the macro impact on loan performance, for instance, and quantify it. Predicting it into the future is a little more fraught, right? And so you can scenario plan what would certain things mean for performance, but that's a little different than saying here's what's going to happen. And that's kind of being able to tease apart those two things, like what's the real impact, what would the impact of X be, and what do you think will actually happen are very different things. And I think we're both cognizant of the ability of data to help you quantify and scenario plan, and cognizant of the limitation of data to help you, accurately forecast. So I said, if I could accurately forecast inflation and savings and GDP and interest rates for the next 5 years, like I would be doing something other than making loans with that data, because that's very useful information. And we're cognizant that
you'd be sitting on a beach somewhere day trading, right?
That's right. You could do very different things with that, but you can also understand what different scenarios would mean, and actually tease out, hey, if these things were to happen, what would that mean? And then allow each of our partners to understand what, from their perspective, they think are the likely scenarios and how that might impact the profitability and availability of lending. So I think expect more from us in the future, because that's an area of active investment, and we think we can really bring some of the data chops beyond the individual risk assessment to understanding of the impact of the macro. And I think it's a really interesting area that you could easily hide from, or just hope goes away when the recession, when the economy is positive, everybody goes, well, it's kind of fine. We don't worry about it until something bad happens again. But, take the opportunity now to really quantify that a little bit and put some data chops to it. Right. So very cool.
And get ahead of it. Yeah, great.
All right, very well. I appreciate your joining us back to have your feet held to the fire on your last prediction and your presentation of a new bold prediction. So we'll have to find a time in 2024 towards the end of the year to have you back and see how this one held up and how bold we feel like it was after the fact. But thanks so much for joining me.
Thank you, Jeff.